Hi, everybody. Good afternoon. This is Dan Sheridan, Sheridan Risk Management. And I wanted to talk today about a trade that's been uh, successful over the last, uh, I mean, for a while, but the last couple months, it's been really good. I mean, part of it is, range bound trades. You think, what do you need for a range bound trade? You need a range bound market, right? And that helps. And if you look at, we're June 24th today. If you look at the last over 3.5 weeks or so. Uh, Today we jumped up a bit, but we've been range bound. But this is a trade that's been pretty resilient uh, for more than the last month or so. And I wanted to share it with you, a tweak to it. So, a lot of times we've been going up lately, right? If you look at a price chart of SPX, you know, uh, over the last 2 months, so this would be the last uh, 2 months or so in the SPX, we've basically been going up, right? From April, we're going up at a pretty good pace, uh, and a little bit of down, and then we've been pretty smooth and range bound. But this is a trade that I like and I do on a regular basis, and we talk about it a lot. But it's the calendar trade, and I'll show you how I tweak it. Um, so again, what is a calendar trade? Calendar trade is simply a mixed month spread. Uh, where you're buying a further out option, in this case, July 15, closer an option, I'm selling July 11 at the 60 and then at the same strike. So a calendar is the mixed month trade where you're buying and selling the same strike. SPX is 60.86 right now. If I wanted a bullish calendar, I would just place my strike maybe at 61.30. 61.40 above the market would be bullish. So I could do a bullish directional calendar. Could I do a bearish? What if I think we're going down? Could I put a calendar at the 60? If we're at 60.86, could I put it at 60.30 below the market? And that would be bearish, yes. Many times I'll just do a range bound trade, put it closer to at the money. So a calendar, so if I do a calendar at the money, where it's 60.86, 87, closer to 60.87, if I place it at 60.90, should be tipped, that would be kind of at the money. You could see here, let me just say this. So I'm buying July 15, selling July 11. So the July 11 is 17 days from expiration, and my long is 4 days further out. You got it? So the July 11th, so this would be considered a 17-day calendar. My shorts are 17 days out. My longs are 21. And this is your graph at expiration in 17 days. This is your graph today. And over time, if I just take the date here and keep going till tomorrow's date, then another date, watch the purple line. As you get further into the trade, that's how you make money. Your purple line will morph towards the blue line, right? If you look at the Greeks, this is a positive, your deltas are pretty neutral, positive theta trade, and that number will grow each day. How do you make money in a calendar? Your shorts, because they expire July 11th, will decay more quicker than your July 15s. So it's a debit transaction. Your risk is what you pay. So here, $5 or $6. If I pay for this trade, let's say I pay $7, the most I could lose is $7. And as time passes, that debit will increase as your shorts will decay quicker than your longs. And so you have this swath or area of where it's profitable. There's your positive P&L, negative P&L, and you can see as long as we're in this area, you're fine. If you go outside, these would be called your expiration break evens, these vertical red lines. If we go outside these areas, that would be problematic to this trade and we'd have to do something, some type of adjustment. But in here, you let it percolate like a good cup of Folgers coffee. But you can see here, if I place the calendar at the money, it's pretty neutral. The deltas are pretty neutral. If I do it at the money, like it's 60.90, my expiration break even on the downside, right? So at the money calendar, the at the money calendar, the expiration break even is around 60.20. Well, what if I want to try to have my cake and eat it too? Dan, what do you mean? What if I place it instead of at the money? Let's say I place it at 60.60. 60.60 is 28 points underneath the market. The cost will still be relatively the same, near $7, maybe a little bit cheaper. I'll make it 680 for a second here. But your deltas are only minus 0.25 deltas short, close to neutral. But what I like about it is, especially on days up like today, I can place a calendar underneath the market. So we're at 60.89. I can place it at 60.60. I could place it at 60.70. I'm relatively close to delta neutral, but by placing it under the market, now my break even instead of 60.20 on an at the money calendar, if I go out of the money on the put side, underneath the market, under the C, now the break evens are like 59.80. So I basically gave myself a head start to the downside. What does that mean? 40 points more room to the downside. And if we go up, I'm nice positive theta and I'm close to zero, right? So one of my favorite trades as of late, and especially I'd rather do it on a day the volatility's down, like today. And so anyways, this was just something I wanted to share with you. And again, what I would recommend, practice it, right? Put it on a couple times, get used to it on paper so you can understand it. All right, folks, have a great day. If you have any questions on this, you could email me, dan@sheridanriskmanagement.com. Check us out. We have live content at least a couple hours a day with me. And check us out. If you have any questions, let me know and have a great day. Thanks.